Hi friends, we are here with one more video on AML. We're going to talk about how to get into the identification and mitigation of risk and what sections or what reference point need to be looked at and what need to be done for those sections. Let's look at those points as we move along. Now, we have already looked at how the DPMS are being classified. So this is just a recap coming from Cabinet Decision number 10 of 2019. Which is giving us a perspective of what is DNFBPs. And we looked at over there for dealers in precious metal and precious stones, anyone who is carrying a transaction, which is a single transaction or interrelated transaction of more than 55,000. So just keep that in mind and we'll go along and see what further sections comes into this. I'll take your attention to one more document, which is a supplementary guidance for dealers in precious metal and stone, which says very specifically one section, irrespective of size of the transaction. Although you are a DPMS, that means you are doing a transaction of more than 55,000, it's a single or multi, that means you are a part of a DPMS. So once you are DPMS, irrespective of size of transaction or method of payment, DPMS should ensure they have in place a process of screening as existing and prospective business relationship and customer against blah, blah, blah. So there are a lot of checkpoints which are there. We're going to go and talk about those reference points in detail as we move into the next slide. This slide is giving a very straight perspective, irrespective of size of the transaction. So that's the point where I want to give your attention towards. Let's look at this. And now we get into a deep dive into specific article or reference point, which is being used and what need to be done for those transactions. So straight away, we get into the Cabinet Decision number 10 of 2019. Concerning the implementation of regulation of Decree Law number 20. So that's where our reference point starts into. There is an Article 4, which says identification and mitigation of risk. Now we're going to go to this point by point and see what are the action points which are required and what is required to be done from immediate basis and for the future transactions also. First, financial institutions and DNFBPs. So it covers all DNFBP, but we are going to focus a little bit on the DPMS especially, are required to identify, assess, and understand their crime risk in concern with the business nature and size and comply with the following. So this is a complete recommendation or a complete recommendatory steps which are being coming up. Considering all relevant risk factors such as customer, country, or geographic risk, product, services, and transactions, and delivery channel, before determining the level of overall risk and appropriate level of mitigation to be applied. Now, the section is giving us a pointer that you should always look at one, the risk from the customer perspective, from the country or a geography perspective, from the product, services, or how the transactions are being delivered. And even the delivery channel is also becoming important. It may not be very relevant for DNFBPs, but it's there definitely. And specifically for DPMS, where physical commodity, which we're talking about. But it's still applicable and we are going to look at how these sections are applied. Second comes a point which says that document the risk assessment operations. That means whatever risk assessment process you have adopted, document it. It should not be that every person who is sitting and doing kind of a validation or assessment applies their own principles. So it has to be documented clearly. And further steps where signature from the top management and other things has to come up is already there in the next sections. But let's understand the factors. Now, what we are talking about, if you see from an AML perspective, broadly three things which we always look at. Customer, what is the profile of a customer? Whether customer is a PEP or not, whether customer belongs to which, what kind of a business he's getting into, what is their background, is there any kind of a red alerts against that customer profile or against the customer ID which is there. Next comes geography. From where the business is coming up or from where the business or the entity or the individual is based into. Are they part of high risk jurisdiction, low risk jurisdiction? What kind of a geographical factors are connected with this? And the last comes product and services. Now in gold, there is a typical thing which we have seen, and definitely it depends on client to client basis. There are kilo bars and there are mint bars. Now the kilo bars or the tola bars which are being used into, now these are bullion which are international market tradable, and the second is mint bars which are technically coins or you can say a small denomination of gold products which are there. Now, if you see typically the more risk or the more money laundering aspect is higher on the kilobars which are internationally tradable. Why? The reasons are not very, I'll not say this will apply to all the businesses, but may apply to some of the businesses. Now, in this case, why we are talking about the differences are because in the small coins or the small denomination, the charges or the value addition is already baked in. So it becomes quite expensive to do any kind of an incorrect transaction. Possible? Yes, possible. Probability of risk reduces? Definitely reduces in this case. So this is what we need to look at, what kind of a product or services we are providing. Are we meeting client personally? Do we know them personally? Had we interacted them? That also becomes part of how the delivery channel is being applied. Or had we only contacted the client on the call and we are initiating the transaction? If that's the case, it's a high risk. So we need to look at those aspects, and these are very effectively, as we saw the article, how it is referring to, is pointing towards. Let's look at further. Now, these are, I have just given a quite a denomination example. If you look at the high risk countries, we can refer to FATF guidelines where they have demarcated the countries from a high, medium, and low risk perspective. If you look at from a customer perspective, we are going to use the world check, or we are going to use any kind of a database which gives us LexisNexis is also one product which is there. Intel Wings has a product which is there. So we are going to look at the profile of a customer. Is there any kind of a red alerts there? Is there any kind of a positive match which may not be very good from a client profiling perspective? So those things becomes important. And as I talked about the product, we are talking about how the gold transactions are being there. In general, we say that gold is a high risk business, but that's within that also we have to look at whether within that it's a high risk or a medium or a low risk activity from a profile perspective. Now, let's look at the point number 2 of the article, which says that, again, we are looking at DNFBPs and specifically to DPMS side, shall commit to take a steps to mitigate the identified risk, which we have already identified the risk. Now, how we mitigate them? I know I have a risk if I deal with a customer from a high risk jurisdiction. Okay. If we are onboarding them, how we are mitigating those risks. So this is where internal policy, control, and procedures has to be designed and developed. That should suffice or compensate with the nature and size of the business also. So a business which is dealing in multi-million dollars may have a different procedures. Like the transaction on the business which is dealing in maybe a few $1,000,000 may have a different procedures. But yes, it has to be documented. So this is a document which is not a generic document. This document is a client-specific document based on the risk and mitigants and the procedures they have in their organization. So this is not a pure copy-paste. This has to be designed for the entity, for the organization, where the procedures are going to be adopted. Now, the second section, which is quite interesting and says very clearly what need to be done, applying CDD measures. Now, what are the CDD measures? One is obtaining more information. Now, here we are looking at information from customer and beneficial owner perspective. Now, beneficial owner is one, again, thing which is getting quite debated and discussed in UAE as we talk right now. So we need to look at, when we are onboarding a corporate relationship, do we know the beneficial owners? Do we know the people behind that? That is definitely required as one of the measures or one of the checkpoint from a CDD perspective. Now, the second point, again, coming back to the previous sections which we talked about, do we have to keep the transactions of more than 55,000 or not? The law or the article itself says that. Now, updating CDD information of customer and beneficial owner more systematically. That means you have to keep their records. Now, how you'll identify that? Example, if I am onboarding an individual, then I definitely require a passport or an Emirates ID or an identity document if both documents are not available. But I will recommend from a UAE perspective, passport should be a case, because we will not find anyone without a passport in UAE, especially expats, where vaccine population is expat side. And from a UAE national perspective, also there will be a passport and a UAE national ID, which will be there. So it has to be there. So definitely passport should be one of the document. But yes, if you have an individual who is a non-resident, that means not residing in UAE, comes as a tourist visa or as a tourist, still the passport is there. So pick up that as one of the information which is required to be obtained and taken. That becomes part of a CDD from an individual perspective. Now, corporate, what we do for a corporate, if it's a UAE, definitely you have a trade license or a registration license. or a registration documents are there if it's not a UAE entity. So corporate documents has to be taken, has to be validated. Now, how you validate that, again, depending on type of risk mitigation we are putting up, depending on type of businesses we are getting into. In some cases on a high risk, definitely there is a probability you will request for attested documents. That means you want it to be maybe a MOFA attestation should be done, or respective other equivalent attestation can be done. So need to look at how the risk mitigation plan as we developed in the point number A of section 2 is being designed into. And next comes identify the source of fund. So if the transaction is happening, there should be a source of fund. We are not saying that we have to look at each penny wise, but definitely if the transaction is, let's say, for 1 million cash, I need to understand how the 1 million cash has been delivered in UAE. Because cash is not a free transaction in UAE. There is a possibility that you withdrawn the funds from a bank, fine. The bank statement along with the withdrawal slip can be looked at, assessed. That's one mitigation. Second, it can be you imported cash from outside, possible in some of the African jurisdictions where there is a scarcity in dollar. Central bank is allowing the currency to be transferred or taken from a country to another, possible. But yes, then in that case, you should have documents which may be equal to the central bank document of the country from where cash is imported, and the import document from a UAE perspective also that cash is being brought inside the country. So those documents become part of the critical. Again, I'm saying this is not a thumb rule. We need to go back to our policies and procedures. How much thresholds we have of cash acceptance, how much of bank transactions we have in acceptance, and beyond that, what kind of a control measures we are going to take or going to ask for to substantiate the transaction. So that's where it goes into. Now, increasing the degree and level of ongoing business relationship monitoring and examination. So there is a possibility you find that a transaction done by one of the individual or a company is frequently increasing. Maybe you have done a CDD of 1 million, considering that the 1 million of business will happen in a year, but suddenly you notice that it's not 1 million, it's 20 million. So you need to look at something more. You need to look at what's happening, where those gold or the business is being, or the goods are being sold further down. So those things become part of your transaction monitoring part. And there is definitely, as I said, when you develop your internal policy and procedure, you are putting up those controls also. What are my threshold? What are my cash threshold? What are my bank threshold? What are my value threshold? Even what are my quantity thresholds? Beyond that, we are going to ask more information. So that's what the expectation or the section is talking about. And then last thing, which is again going as obtaining approval from senior management to commence the business relationship with the client. So you look at applying CDD measures. While you are applying, you have done broadly 3-4 things. One, you identified the relationship with you are dealing with, which can be through the UBO or through the customer documentation or through the individual itself. You have done a CDD measure by applying the principles or data scrubs we have done, identified. You looked at the source of fund. You looked at whether the transactions are reasonable. So these are transaction monitoring. This may not happen at the time of onboarding, but that's part of the CDD measures, which can be an ongoing process, and approval from senior management. So these are pointers which are coming up. Now, the point number 3 of the article, which says, in case required stipulated in clause 1 and 2, which we have read before, above are met, the financial institution and DNFBP shall be permitted to apply simplified CD. So you have done all things, you have all documents, you have all information, and you are comfortable as per your risk management that transactions are aligned. Then what? Then you can do a simplified CDD. Now, simplified CDD also require us to have a minimum information of verifying the identity of a customer. So that means the documentation which are required for onboarding an individual or onboarding a company remains same. Uploading customer database on less frequent intervals. So I can update the information in more less frequency. Like I'm not going to do everything every year. Maybe I can take a risk-based approach that I will verify these things once the trade license is expired. Now, unfortunately, we say UAE has a 1-year life cycle of a trade license. So we have to get the trade license renewed. But yes, if it's an individual and his visa is valid, Emirates ID is valid, we can go for a period for which the visa is extended into. Again, going back to the risk management, going back to the policy and procedure, what is documented has to be looked into. Now, reducing the rate of ongoing monitoring. So if you feel that transactions are within the threshold which you have adopted as per the risk-based approach, yes, you can again go by reduced monitoring. You will check maybe after 6 months, you won't check in every month. Going back to again the principle, is again a risk-based approach. It cannot be standardized. It has to be looked at the business and the model what you are adopted into. Conducting the purpose and nature of business relationship. Now, why this relationship is being entertained or managed, and what the client is doing by buying a product from you, that also need to be looked at. There can be individuals who are buying the bullion only on account of investment. There are people who are buying for utilization like a jewelry. All that is fine, but you need to know, you need to document, you need to record those aspects in the transaction or in whatever monitoring you are doing. So my take goes into whatever we are doing, it has to be looked from a transaction perspective. Now I'll give a pause here and I want to show you something very interesting. Give me a minute, we will start on that side also. Okay, we are back. Now, if I show you the screen, now this is basically one of the risk-based approach which is being designed. Let me give a little expansion of here. So this is again a risk-based approach which is being adopted. Now there are some pointers which are being highlighted and being designed as part of the workflow, which can be looked at how it is done. Example, first question we are talking, UBO known, if it is yes or no. If it is UBO is known, it's fine. If it is no, you can see the answer. It says that UBO is not known, client cannot be onboarded. Now this is based on one of the risk-based approach we have adopted for one of the client, and this is how it is going into. If I say yes, fine, it takes me to the next screen. It says the data screen or a sanction check is being done or not, and there's no positive alert, which is being fine. So if no, you can go further. But if I say yes, you can say the client cannot be onboarded. So this is where the data is stopping us to take off the transaction. I'll just expand it to see what is a full comment. Since data screening sanction check, adverse media not approved by CO MLRO, client cannot be onboarded. So this is again one of the stopper which comes into play. We go into the further section, a cross-border transaction to or from a country of a high-risk jurisdiction subject to call for action. So this is where again, as per this risk-based approach, we said if it is yes, the client cannot be onboarded is a final comment which is coming in. If it is no, my risk-based approach says perfectly fine, move on, it's okay, the transaction can go ahead. We are looking at PEP. It's not a PEP or it's a PEP. If it's a PEP, we are not stopping the transaction, but we are converting into a enhanced due diligence. So that means further actions are required, further additional information is required. Maybe a senior management approval is required to ring fence the risk on the PEP perspective. Now, if I say no, I can go to the various parts. Now, these are the approaches which are used. Example, one of the approach which you are looking at is whether a client has a VAT registration in UAE or banking relationship. How it makes a difference. It definitely makes a difference because the client is registered on the tax portal or with the banking. That means a certain level of due diligence being done. So here what we have done is we are given a scoring. That means a percentile being given. If you see 10, the different percentiles are given. And we are looking at whether it's a high risk or low. Just giving a quick perspective on that. So this gives us a final scoring of high, low, medium as whatever we talk about. So if I change some of the denominations just for the quick benefit, not to make this video too long, you can see my denomination changes, and the moment denomination changes, the client converts to a high risk. So this is one of the method which can be used from a risk management perspective and a very effective method. But again, this is not a standalone thing. It has to come from the policy and procedure and the risk adoption, which is done from a client perspective. So let me stop the screen here. So this is where I'll say when we are talking about a transaction of more than 55,000 has to be reported, it's something not new. It is already known. It is part of the law. It is part of the framework. Now, what I think the challenge which is coming up is how frequently this data has to be uploaded. What are the formats required? What are the information required? That's perfectly fine. I'm sure regulatory bodies are going to come up with the information very soon and will be helpful to all. Thank you very much. Hope you liked the video. And if you like it, do give a thumbs up and do subscribe there are more and more videos on this topic, and various other taxation things are going to come up very soon. Thank you. Have a great time. See you till we meet together. Bye-bye.